Hello everyone, welcome to my channel where I talk about personal finance. Today I'm going to talk about should I pay off my mortgage early or invest? Let's get into the video. Deciding whether to pay off your mortgage early or invest is one of the most important financial decisions homeowners face. This dilemma involves balancing the benefits of debt reduction with the potential gains from investments. While some might lean towards the security of eliminating a large financial obligation, others might see the value in leveraging low mortgage interest rates to grow their wealth through investments. Both options have their advantages and drawbacks, and the right choice depends on your individual financial situation, risk tolerance, and long-term goals. In this video, I will explore both strategies in detail, comparing the benefits and trade-off so you can make a more informed decision. Understanding your mortgage. Before driving into whether paying off your mortgage early is the right choice, it's important to understand the basis of your mortgage. Interest rates. The rate of interest you are charged on your mortgage plays a key role in this decision. A higher interest rate may make paying off your mortgage early more attractive, while a lower rate could make investments more appealing. Long-term mortgages typically last 15 to 30 years. A shorter-term mortgage, example 15 years, often comes with a lower interest rate, which makes it more challenging to justify investing rather than paying it off early. Conversely, a longer-term loan at a low rate may present more opportunities to invest. Next, monthly payments. Your mortgage payments include both principal and interest. Early payments go largely towards interest, and paying extra early in the life of the loan can reduce the total amount of interest you pay. Tax deductions. In some cases, mortgage interest is tax deductible, which can reduce your overall tax liability and make holding onto the mortgage more appealing. However, recent changes to tax laws have limited this deduction for many homeowners. Benefits of paying off your mortgage early. Interest savings. Paying off your mortgage early can save you a significant amount of money in interest over the life of the loan. Since mortgage payments are amortized, the bulk of your early payments go towards interest rather than principal. By making extra payments, you can reduce the interest you pay and shorten the life of the loan. For example, let's say you have a $300,000 mortgage at 4% interest over 30 years. If you make just one extra payment of $500 per month, you could save tens of thousands of dollars in interest and pay off the loan years ahead of schedule. Secondly, the financial security. Eliminating your mortgage payment provides a sense of financial security and peace of mind. Without the burden of a monthly payment, you will have more flexibility to allocate your income towards other financial goals, emergencies, or even retirement. Especially for those approaching retirement, being mortgage-free can reduce the stress of fixed expenses. Not having a mortgage means you will need less income in retirement, making your retirement savings last longer. Guaranteed return. Paying off your mortgage early is a guaranteed return on investment, equivalent to the interest rate on your mortgage. If your mortgage has an interest rate of 4%, Paying it off early gives you a 4% return on your money, which is risk-free. This is especially appealing in a low interest rate environment where investments such as bonds or savings accounts may not provide a comparable return after factoring in taxes and inflation. Improve cash flow. Once your mortgage is paid off, your monthly expenses will decrease, freeing up your income for other purposes. This can provide you with more flexibility to handle emergencies, invest in other opportunities, or even enjoy discretionary spending without the worry of a monthly mortgage payment. Psychological benefits. For many people, the emotional and psychological benefits of being debt-free are significant. Knowing that you own your home outright can provide a deep sense of accomplishment and reduce financial anxiety. It also eliminates the risk of foreclosure, providing added peace of mind in uncertain economic times. Drawbacks of paying off your mortgage early. Opportunity cost. One of the biggest drawbacks of paying off your mortgage early is the opportunity cost. If you have a low interest rate mortgage, the money you use to pay it off early could potentially earn more in investments like the stock market, real estate, or other growth-oriented vehicles. Historically, the stock market has provided average returns of around 7 to 10% annually, significantly higher than most mortgage interest rates. By paying off your mortgage early, you might miss out on these potential returns, which could have a more substantial impact on your wealth over time. Liquidity concerns. Your home is an illiquid asset, meaning it's not easily converted to cash. By paying off your mortgage early, you are tying up a large portion of your money in your home. If you ever face a financial emergency, you might not have the cash on hand to cover it, unless you take out a home equity loan or sell your home. Limited tax deductions. While paying off your mortgage early reduces the interest you pay, it also means losing out on the mortgage interest deduction for those who itemize deductions on their tax returns. This could lead to higher taxable income, especially if you are in a higher tax bracket. However, with the standard deduction now much higher due to changes in tax law, many people no longer benefit from the mortgage interest deduction, making this point less relevant for some homeowners. Benefits of interest investing instead. The benefits of investing instead. One, higher potential returns. The stock market has historically provided higher returns than most mortgage interest rates. If your mortgage rate is 3.5% and you invest in a diversified portfolio that returns 7% per year, you could potentially grow your wealth faster by investing rather than paying off your mortgage early. Over the long term, the power of compound interest can significantly amplify your investment returns, providing a great overall return than the investment savings from paying off your mortgage. Secondly, compound growth. Investments in stocks, bonds, and other assets have the potential to grow exponentially over time. The earlier you invest, the more time your money has to grow through compound interest. This could help you achieve long-term financial goals such as retirement, education, funding, or large purchases. Another benefit of investing instead is liquidity. Unlike your home, most investments can be easily liquidated if needed. This Liquidity can provide a financial cushion in case of emergencies or unforeseen expenses. If you have a robust investment portfolio, you can always access your funds more readily than equity tied up in your home. Next is diversification. Investing provides the opportunity to diversify your financial assets, which can reduce overall risk. Instead of putting all your money into one asset, your home, you can spread it across different asset classes such as stocks, bonds, real estate, investment trusts, REITs, and more. This diversification can protect your wealth from being overly reliant on one source. Tax benefits. Certain investment accounts such as 401ks or IRAs offer tax advantages that can increase the efficiency of your money. Contributions to a traditional IRA or 401k are tax deferred, meaning you won't pay taxes on the money until you withdraw it in retirement. Roth IRAs offer tax-free withdrawals, which can be particularly beneficial if you expect your tax rate to rise in the future. Now, the drawbacks of investing instead of paying off your mortgage. Market volatility. While the stock market has historically provided strong long-term returns, it also comes with volatility. In the short term, market downturns can lead to significant losses, which might make it more difficult to stomach the risk. If you invest instead of paying off your mortgage and the market underperforms, you could end up losing money while still carrying your mortgage debt. Uncertainty is the next thing. Investment returns are not guaranteed. Unlike paying off your mortgage, which provides a guaranteed return equivalent to the interest rate on your loan, investments in the stock market or real estate come with varying levels of risk. There is always the chance that your investment would not perform as expected, leaving you in a worse financial position than if you had paid off your mortgage. Debt risk. Carrying debt, even low interest mortgage debt, comes with inherent risk. If your financial situation changes, such as a job loss, health issue, or unexpected expense, having a mortgage to pay can add financial stress. If you invest instead of paying off your mortgage and find yourself in a cash crunch, you could be forced to sell investment at a loss to cover your mortgage payments. Factors to consider in your decision. To make an informed decision between paying off your mortgage early or investing, consider the following factors. 1. Interest rates. Compare the interest rates on your mortgage to the potential returns on your investments. If your mortgage rate is higher than what you expect to earn from investments, paying off your mortgage might be the better choice. Time horizon. How long do you plan to stay in your home? And how long can you let your investments grow? If you are close to retirement or plan to move in the near future, paying off your mortgage may provide more immediate benefits. Risk tolerance. How comfortable are you with risk? If you prefer certainty and dislike market volatility, paying off your mortgage provides a guaranteed return and peace of mind. On the other hand, if you are comfortable with risk and have a long-term perspective, investing could provide higher returns. Financial goals. What are your short-term and long-term financial goals? If building wealth is a priority, investing may align better with your goals. If debt reduction and financial security are your main concerns, paying off your mortgage early could be more satisfying. Emergency fund. Ensure you have an adequate emergency fund before making any decision. If your savings are insufficient, prioritize building a cash. Thanks for watching this video and do not forget to subscribe to my channel.